Okay, so good afternoon and welcome to today's program, Budgeting Your Way into Home Ownership. I'm Nicholas Cunningham, the Program Manager of LVAIC. We have a great presentation for you today, led by Leanne Machuzik and Steven Slosky from CrossCountry Mortgage LLC. Leanne and Steven will share important information for those who have goals about buying a home or any other housing investments. Before we begin, please be aware that we are recording this session. We ask that you put questions in the chat throughout the presentation, as we'll be answering everything at the end when we stop the recording. And now I'm going to turn everything over to Leanne and Steve.
Good afternoon, everyone. I am Leanne Machuzik, and my partner is Steven Slasky. I have been in the real estate industry for 32 years, having started out in property management and then as a realtor. I'm also an investor, and now I'm also a loan officer with CrossCountry Mortgage. With that experience, I bring a little extra to my clients. Prior to being a loan officer, all of my personal loans and all of my clients were referred to Steve Slasky. Steve?
Hi guys, Steve Slasky. Yeah, I've been in the business since about 1998, which makes me sound as old as I look. I've got some real estate investor experience of my own personal and, done everything across the gamut of mortgages, from your non-QM, which are your no docs, bank statements, investment properties, commercial, all the way through the FHA loans. So yeah, just happy to assist Leanne any way that she needs.
Thank you, Steve. So I wanted to go over a little bit about what we're going to go over today. This can be a very stressful situation that people go through, and we want to make sure that you are educated in the right sense, so that way it makes the situation a lot easier to go through. So we're going to go over mistakes that people make, what you're supposed to do first. Since education is a big part of my goal for you today, we're going to go through some terminology that the industry uses, the breakdown of what a mortgage payment consists of, what FICO scores are, if you should rent or buy. We'll go through the budget and the process and some different types of loans, and then we'll have a question and answer session at the end. So mistakes that people make, they're due mostly because buying a house can be stressful. It is usually the largest purchase of a person's life and creates intense pressure. The process is complex and will involve people that you don't know, and you'll need to rely on them. Our job is to help you get through this as easily as possible. Knowing what to expect will help you tremendously to alleviate the stress. So a big part of the mistakes people make is, first and foremost, not having a budget. Not knowing what you can afford is going to impact your home buying tremendously. So you don't want to shop for a house without getting your pre-approval first. The worst thing you're going to do is go and look at houses that are above your budget, and you're going to fall in love with them and then realize that your budget might be lower and that you can't afford what you wanted. So having to remove all of that off your plate is very difficult sometimes. Not knowing the process, not having an experienced realtor, and not having a reputable lender. A lot of times when you're in the negotiation part of trying to put a contract together, if the listing agent does not know the lender that you're working with and they're not local, very typically they will choose somebody else. There are times where you're thinking you have to have at least 20% down, or you have to have perfect credit. Those are all misnomers. There are plenty of things plenty of different loans that you can go through that do not require 20% down. And then very, very importantly, not knowing how you can jeopardize your process of your loan after you go under contract. Oops. So first and foremost, get your pre-approval first. And I'm going to say that over and over. So you're going to need to know what your budget is. How much can you afford? So I always tell everybody, know what your two numbers are. Those two numbers is what makes you comfortable, how much money you can pay every month for your mortgage, your taxes, and your insurance. What makes you comfortable? Because you may want to take your trip to Rome. You may like to go to the shore for the weekends. You may have other hobbies that take up a portion of your funds, and nobody wants to be house poor and not be able to do those things. So you need to know what your comfortable number is. You also need to know what the highest amount is that you can be pre-approved for. That being said, that's where we come in and we can help you figure that number out. Oops. Terminology that the industry uses. I'm going to go through some of these. A lot of them are a little self-explanatory, some are not. So your down payment is the portion of money that you are going to put down on your loan. Your loan could be $300,000, or the purchase price could be $300,000, and you may want to put 10% down. So your down payment would then end up be $30,000. Your down payment is different than your closing costs. Your closing costs are all of the costs associated with you buying that loan. Those costs are taxes, such as your transfer taxes. They are taxes dealing with your real estate taxes, with your local, county, and school district taxes. They are part of your title insurance, all of the fees that go into purchasing a house with an appraisal or any of your title insurance and any of their costs. It also includes your realtor commission amounts. Gift funds are funds that you can receive from your family member. They are not a loan, and your family member would need to write a letter stating that this is not a loan and that they do not expect it to be returned back to them. This can help you towards your down payment and your closing costs. It's not definitive as to which. So that can also be done to help you get your down payment and closing costs paid for. One of the other things that can help is seller assist. So the seller does have the ability
Is Leanne frozen on your end, Steve?
Yeah, she is.
Okay, we'll give her a second to see if she can come back. And
Okay. Yeah, I mean, I can jump in and
Sure.
kind of chat through until she picks back up.
Mhm.
I think she was touching on seller assist. So
Yes.
seller assist is where the seller can help contribute to closing costs. And there's a certain percentage allowed based on different programs that the borrower qualifies for. Leanne, are you back up?
I am. Can you hear me?
Okay. Yep.
Okay.
Good to go.
Okay.
So I covered seller assist if you want to jump into closing cost estimate.
Okay. So your closing cost estimate is something that both your lender and your real estate agent will provide to you. This is a document that shows you a layout of all of the costs that it would be associated with purchasing your home. They are supposed to give one, the real estate agent is supposed to give one to you prior to signing your contract for the house. And you will also get what is called a closing disclosure as well from your lender. You're going to have a couple of them. You're going to have your initial closing disclosure, which you'll receive after you sign for your application and start your loan after you go under contract. You're going to have a final closing disclosure, which is required 3 days prior to closing. And all those numbers are going to show you is your interest rate loan for the loan, any points that you have to pay, any other costs that are associated with your loan. So then you're going to have an interest rate and your rate lock. Your interest rate is how much you're paying to the bank for that loan. So interest rates a few years ago were extremely low. They were unnaturally low, which is what also helped create this boom of purchasing. Interest rates have gone up since then. They are sitting at this point. It will depend on your credit and your loan amount and your down payments. But they're sitting in the upper sixes at this point for most. When you get a pre-approval, we can give you an idea of what your interest will be, but you can't get an exact amount on your interest rate from any lender until you have locked the loan, because interest rates fluctuate constantly. So you can have one interest rate in the morning and it can change 3 times that day. Points are also another way of reducing your interest rate. Think of this as prepaid interest. So when you're talking about points, 1 point is equal to 1% of your loan. So if your loan is $300,000, 1 point is going to be $3,000. It does not lower your interest rate a full percentage point. It only lowers it a partial point. So keep that in mind when you're talking about points. Debt to income ratios. So your debt is what your monthly expenditures are compared to your income. So when we look at your income and how much your debt is, we're going to try to get that ratio as close as we can to about 45 to 50% in order to figure out how much you can qualify for. The lower your debt and the higher your income, the better off you're going to be, obviously. Loan to value is basically determined on how much you're putting down on your loan, your down payment. So if you put 10% down, I'm using that $300,000 that we did before, you now have a 90-10 loan to value ratio. Mortgage insurance is something that the insurance companies, it's something that the mortgage companies apply when your your loan to value ratio is under 20%, your 80-20%. Once you hit 20% on a conventional loan, then that mortgage insurance will fall off. For an FHA loan, it will stay for the life of the loan. Homeowners insurance, that is required by your lender to have on your home in case of any perils or hazards. You will also hear it called hazard insurance as well. A cleared to close is the final words that you want to hear every lender say. It means that you can go ahead and close on your house. So you get that when you have your final approval for the loan process. An appraisal is when you need to pay for an appraisal. The mortgage company will set up to have a third party do the appraisal. You'll get a link, you'll pay for it, the appraiser goes out. What the appraiser does is he places a value on your house. If your purchase price is above where the appraisal comes in at, you either have to renegotiate with your seller or you have to make up the difference in cash. Depending on how your contract is written, you may be able to walk away from the sale. Your earnest money deposit is it's not a down payment, but it works in a sense that, think of it like a security deposit. It's an amount of money that you will put down, and it's held by the title agency that is going to do the closing on the house, or it can be held by the broker of the listing agent. And it shows that you have skin in the game. So realize that this is money that's going to need to come out of your pocket in order to purchase your house up front. When you get to closing, that money will then be applied towards your closing costs and your down payment. Title and title insurance. So title is when there's going to be a company that does your closing, and they're going to make sure that the title and the deed are clear of any encumbrances or any claims upon that house, that property. So that way, years down the road, somebody can't come in and say, "Oh, well, that house was gifted to me. I should have had it. I'm the rightful owner." They check and they make sure that the chain of title and the deed is completely clear. It's free and clear for you to purchase that house. And last, amortization is a printout of how many payments you're going to make over the life of the loan. And it will show you how much in interest and how much in principal each one of your payments will be as you go through the repayment of your loan. In the beginning of your loan, you're paying more interest than you are principal. At the end of the loan, you're paying more principal than you are interest. So what makes up the mortgage payment? So you'll hear the term PITI, which is principal, interest, taxes, and insurance. And then also there's homeowners association fees. So the principal is the actual repayment of the money that you owe back to the lender. The interest is applied every month. And in the beginning of your loan, of course, you pay more interest than you do at the end of your loan. But your principal and interest will never change over the life of your loan unless you decide to refinance and get a different rate. Your taxes, for the most part, most of the loans require your taxes to be included. There are times when you can ask for your taxes not to be included, and same thing with your homeowner's insurance, and then you would pay them separately, but they do still need to be paid as a requirement of your loan. Your taxes are going to cover, for our area, they're going to cover your county, your local, and your school district taxes. The taxes will change if you move to different areas. There are some states that have much lower taxes. There are some that have much higher taxes. Same thing with homeowners insurance. Your homeowners insurance and your mortgage insurance. The mortgage insurance is never going to change until you hit 78% of your loan to value. Or you can contact the mortgage company and ask them when you hit 80-20 loan to value. So your homeowner's insurance will need to be paid every month, and as will your taxes. And you're going to pay those into an escrow account. And then once a year, the mortgage company will pay your taxes and in your insurance for you out of that escrow account. If your taxes increase or your homeowner's insurance increases, then they will contact you and they'll redo your mortgage monthly payment to allow for the increase in the taxes and insurance. But your principal and interest will never change over the life of your loan. And then if you have any homeowners association fees, those are also going to be calculated as part of your mortgage payment, although for the most part, you're going to pay those separately. So we look at a FICO score. There are 3 credit bureaus, Experian, TransUnion, and Equifax. And what they do is they look at how much debt you have and how well you pay it back. And when they do that, they're going to place a number on how well you do. It's your report card. Now, when you apply for a loan or you do your pre-approval, we'll do what's called a soft pull on your credit. Every time you do a pull on your credit, it can lower your score. So If you go out and you try to get 5 different credit cards and then come and tell me that you have really good credit, and then I do a soft pull on your credit, and now your credit score is a lot lower, it's because you have opened up new lines of credit, and you have also been looking at your score. So it believes that you're going to open up new credit, even if you decide not to. When you go under contract, that's when we will do a hard pull on your credit. That is the time where it could lower your interest or lower your FICO score. If your FICO score goes too far down, it will affect the amount of your interest that you could get on your loan. Let's see. The lower your score, the higher your interest rate's going to be. So if you have a score that's pretty much 720 and higher, you're considered pretty much in a good area. I know that chart here says 740, but it's really 720. And you can see just the different factors that the credit bureaus will look at in order to place the value on your FICO score. If you need to figure out how to make your score higher, you can call us to get a customized plan for you. My phone number is listed there. I also have a link in the chat, so that way you can also go onto my website and you can apply there, and I can contact you and we'll work through a plan for you. So everybody wants to know, should I rent or should I buy? So if you rent, well, you've got high rents, especially in this area, and they keep going up. You're always going to be paying somebody else's mortgage. And then you have to move. You know, the landlord can make you move at the end of your lease term. If you're buying, you're not going to have to worry about your payments increasing, except for taxes and insurance. Those do go up, but your principal and interest will stay the same. And you're always going to be building equity, and you can use that equity that you built in the future if you decide to. And nobody can make you move as long as you pay your mortgage. So you have stability. When you're renting and you move out, you don't have anything. So, and you might get your security deposit back. If you're buying, you still have that stability of knowing that you have whatever equity you have built into the house. You also get tax advantages on your mortgage interest at this time, unless somebody changes it. But at this point, you can still write off your mortgage interest for your home. Now, for renting, you're not responsible for maintaining the property, which that might be something big for you, because when you do buy a house, you're the one that's responsible for everything, and that can be costly. So if you're looking for a short-term living need, then by all means, you want to rent. But if you're looking for something that you can stay in for a long period of time, you're definitely going to want to buy. And, you know, as well, as a con, the upfront costs can be expensive when you're purchasing a house. So when we talk about your equity that you're gaining in your house over a period of time, historically, home amounts have always increased. There may be some dips, but the prices have always gone up. So this chart shows you from all the way back from 1965 all the way up until 2025. And this is coming from the US Census Bureau. That you can see all of the increases over the time, or, you know, over the last so many years. And the shaded areas are, excuse me, they indicate US recession times. So that's why you'll see some of the dips happening at those times. So we work on a budget for you. And so what I did was I put up an example for Anita. Anita makes $80,000 a year as her salary. She has about $15,000 in the bank, and her FICO score is at a 736. And she's making her $600 car payment, and she's got about $93 of credit card payments every month. Now, when we look at your credit card payments, we're only taking the monthly minimum amount due. So you may have more in credit card payments because you choose to pay more. But when we look at your credit, we only look at your monthly payments. So we figure you have $693 outgoing every month. So we can take now this is just a really, really rough rule of thumb. So we take your gross monthly salary and we can divide it in half, and then we can subtract your monthly payments. So you can see here the monthly amount that she gets is $6,666.67. So we divide that by 2. And then we subtracted the $693. This is telling me, as a rough guesstimate, of $2,640 per month is what she can afford for her mortgage payment. Now, when I put everything into the mortgage calculators that I have, I'm going to look at it and say, okay, she's got about $15,000 in the bank, so we're going to need to get her an FHA loan. She can actually purchase a house for about $300,000. And at this point, her interest rate was 7%. That was using something from last year. But I'm always going to show you a 7% interest rate at this point because I want to estimate high. Her down payment on a $300,000 house for an FHA loan is 3.5%. So she needs $10,500 for her down payment. Her closing costs, which are equaling her transfer taxes, her real estate taxes, her appraisal, her title insurance, homeowner's insurance, that's about $15,500. So her total estimated cost is $26,074.25. I know that she only has $15,000 in the bank. So since she's using an FHA loan, we're going to, when she negotiates with the seller, she's going to ask for some seller assist because she can do that on this loan. And then she's going to end up getting into her home that way. Principal and interest, the breakdown for the principal and interest, the homeowner's insurance, taxes, and mortgage insurance is all there, which totals out to $2,592. We're going to round it up. So you can see that she's close to $2,600 a month with the mortgage calculators. So that rough rule of thumb of $2,640 is really not far off. That's why I say it's a rough rule of thumb. So just use that as just a slight base. Now her taxes, they could be higher or lower. Her homeowner's insurance could be higher or lower. Those are things that are going to change based on each individual house. If you want to use any of my mortgage calculators, you can do that. My website email or the website address is listed right there, the ccm.com/Lee. Dash and dash Montujek. And then you can go to the resources button for the calculators that are on my webpage for you, and you can use them as much as you need to. So what do you do first? You get your pre-approval. Always, always get your pre-approval first. The documents you're going to need, if you're employed, I need your last 2 years of W-2s and your last month's worth or 30 days worth of pay stubs. So if you get paid once a month, I need 1 pay stub. If you get paid every other week, I need 2 pay stubs. If you get paid weekly, I need 4. Self-employed people, or if you have any investment properties and you collect rent, or if you're a self-employed person, I need your last 2 years of taxes. If you're retired, I need an award letter from Social Security. If you have any IRAs or pensions or any trusts, I want your statements from them as well. Everyone should also know what your balances are in your bank accounts for your down payment, closing costs, and reserves. Reserves are it's basically money that you have in reserve in case something happens. You can actually attach, you can go to it to pay your mortgage. If you pay or receive child support, I need to get a 6-month history from you for that. And I also need your government issued ID. If you plan on using a VA loan, I need your DD 214. So what kind of loan will you use? Well, it depends on your individual situation. It's going to depend on how much money you have to put down, and it's going to depend on how high or low your credit score is. If you need seller assist. So you can actually use a conventional loan as a first-time home buyer. That means that you haven't owned a house in the last 3 years or more. You can do a conventional loan with as little as 3% down. And an FHA loan, you can use a 3.5% down payment, but you will have your private mortgage insurance for the life of the loan. As I said before, with conventional, once you get to that 80-20 loan to value ratio, your mortgage insurance will fall off. USDA loans, they have 0% down. They are typically used for rural areas. It does not mean that you have to buy a farm. You can go, even in our area, you can go outside of the city limits. You can use a USDA loan in parts of Nazareth, all the way up through Moore Township, Lehigh Township, out to Macungie. Like, there's a whole area, a very significant area in our area that you can use the USDA loan. Income limits do apply. So again, we'll work with you to see where your income is and all of that, so that we can figure out which loan is the best for you. With a conventional loan, depending on your down payment, you can ask for up to 3% of the loan amount for the seller assist. Of course, you have to get the seller to agree to that. For FHA, you can ask for up to 6%. Same thing with the USDA and the VA loans. They're also up to 6%. VA loans do not require anything down, but they do still have closing costs. You do need to be a veteran. Again, if you're a veteran, you know what a DD 214 is. It basically gives you permission to use a VA loan, but you will not have any private mortgage insurance. We also do loans for refinancing and what's also called a cash out refi. So you can refinance if you have an FHA loan and you know that your loan to value ratio has gone under that 80-20. So you're now less than 80%. You can actually refinance into a different loan so that you can get rid of the private mortgage insurance. If you have enough equity in your house and you maybe want to go buy another property, or you want to do renovations to your own house, whatever it is that you want to do, you can do a cash out refinance. It will take whatever interest rate that you had, get rid of it. You're going to start a whole new loan with a whole new interest rate. So those interest rates are going to be the current interest rates in the market at that time. And we can do these on primary residences or investment properties. We can also do these on second homes and vacation homes as well. If you ever decide you want to become an investor, we can do the DSCR loans for condotels, multi-units. DSCR loan just means that the property, how much rent it's getting, has to be able to pay for the loan. We can also do a home equity loan, again, for primary residences or investment properties. And we can allow you to get whatever equity is in the house in order, again, to do renovations or whatever it is that you need to do. So What if you don't have enough for your down payment and closing costs? You're not stuck. You can get gift funds. We've talked about that. Maybe your mom and dad or your aunt and uncle or brother or sister is really, really nice and they would like to help you out. You can get those gift funds. We would need, again, the letter that states that it is not a loan and that it is a gift, and we can use that for your loan, for your down payment closing costs. You can also tap into retirement funds if you need to. If you have a 401k, typically they do allow you to tap into those funds and then pay them back later. There are certain loans that require a lower down payment. So don't think that you have to have that 20% down. That is something that a lot of people don't realize, that they can do that. You can, as a first-time home buyer, you can get into a house with a 3% down amount. Or you can use the USDA loan and get 0% down. There are also down payment and closing cost assistance programs. We do work with different programs like the Chenoa Fund, First Front Door, but we also work with some closing cost assistance programs where you're taking a second loan for your down payment and closing costs. So that is something that is also available if you need to. And then finally, there is always seller assist, but again, you need to get the seller on board to agree to that. So the process with your loan, you have to obviously first get your pre-approval letter. Obtain the services of a realtor to find your home. Yes, you need one. Once you go under contract, we need a copy of the agreement of sale and a copy of your earnest money deposit. We'll have you sign your initial closing disclosure and the application. Your loan is going to go through a few different stages. You're going to have an opening, which is where the office will contact you. They're going to get all the small details. And it's going to go into the initial processing, which is where they're going to ask you for all kinds of paperwork. They're going to need all kinds of bank statements, verification of employment and income and different things. So don't think that just because you have your pre-approval letter that there's not additional things that are going to be needed. Then it's going to go into an initial underwriting. That's where an underwriter is going to look at the entire package and say, this is what else I need in order to make this loan go through. At that time, you're also going to have to pay for your appraisal, which is done through a third-party company. It used to be a long time ago that the appraisers and the lenders talked to each other, and then the mortgage crisis happened, the housing crisis of 2008 and 7, all that happened, and regulations had to be changed. So no longer can the lenders speak with the appraisers. It has to go through a third-party company. You can pay for that on a credit card. That's fine. We know that that's going to happen. You're going to have to obtain your homeowner's insurance policy binder. Now you can pay for that in advance or you can pay for it at closing, but we just need to have a binder that says from the homeowner's insurance company that the lender is the mortgagee. You're going to, at that point, get what's called a conditional approval. It's also known as a mortgage commitment. Your mortgage commitments are typically due about 2 weeks prior to your closing. The mortgage commitment says, we will give you a mortgage based on these necessary items being completed. And you're going to work very closely and directly with the processor to get any additional information they need. Anything that the processor asks for, get it to them as soon as possible. Do not delay. If you delay, it's going to possibly delay your closing date. At that time, we're going to lock in your rate. So that way, we're going to be looking at the markets and we're going to watch the 10-year Treasury bond. We're going to be watching which meetings are coming up just in case something's going to happen. We know when to lock in your rate for the best time and the best rates. Once all that information has been verified, you'll get your clear to close, which means that you can go close on your house. And the title company will then jump in and they will balance the settlement sheet with our closing department. And then you get to go to settlement and you have your home, you get the keys. Now, I would be remiss if I didn't go through the process with your agent. You're going to have two different things happening. One is to get your mortgage and the loan process, and that's all going to be through your lender. And then you're going to have things that you're going to be working on with your agent. So obviously your agent's going to want you to have that pre-approval letter because they want to make sure that they're not showing you houses that you can't afford. You're going to sign a buyer agency agreement with your realtor. You're going to shop for your house. You'll find your house and you're going to sign an agreement of sale with a seller and you're going to go under contract. Then you're going to deliver your earnest money deposit either to the title company or to the listing agent's brokerage. And you're going to need to send us a copy of that. Your agent will order the title insurance for you, or we can do that as well if you need us to. You're going to do your home inspections if you choose to do so. There would be additional negotiations at that time if necessary. You're going to wire your funds at the end to the title company doing the closing. Now, wire fraud is rampant. So if you have somebody contacting you that says you need to wire your funds to a different place or it has changed or anything of that sort, you hang up, or you don't even hang up. You're not even going to be on the phone with them, hopefully. You're going to call your agent. You're going to call the title company that they tell you they have ordered it from, and you're going to confirm with that title company that they are in fact the ones that have sent you that information. It has happened where people not knowing this, they have wired their funds to a different title company or what they thought was a different title company, or they may have even thought it was their correct title company. And then when they got to closing, the title company says to them, "Where are your closing funds?" thinking you might have a certified check. And when you don't, your money is already gone. They're really getting bad. So wire your funds directly to the title company doing the closing. Settlement day and the key and the home, they're yours, but just make sure that throughout your process that you're working with your realtor regarding timeline contingencies, because certain things have to happen by certain times. And the contract will require these things to happen at those times. So your agent will make sure that you stay within those contingency timelines. Do not, under any circumstances, or no, I shouldn't say that. Don't open any new credit accounts if at all possible. Don't take on any additional debt. Don't co-sign for someone else. Don't quit your job. We have had that happen. I've seen it where somebody was leaving their job and at closing, the lender did a verification of employment on that day because they have to do one within 5 days of closing. And they found out from the company, oh yeah, yesterday was their last day. And it turned out that they had been starting a new job. They just didn't tell anybody. So it was an issue, and they did get it through, but it took a little bit more time than expected. If something happens, and things do happen, I mean, I've had people where, you know, their car got into a car accident and it was totaled and they had to go get a new car. So if something happens, contact your lender as soon as possible and let us know what has happened so that we can walk you through getting the right documentation to keep your loan going smoothly. So maybe you're moving out of Pennsylvania. Can I still help you? And the answer is yes. Steve and I can cover all 50 states for loans, and we also have a vast network of realtors for you to work with in all the states. My contact information, again, is listed here. I have my website listed there, and my email is also listed here. So if you have any questions, please, let's do a question and answer session. If anybody has any questions, Steve and I would be more than happy to hear any that you have.
All right, thank you, Leanne and Steve. So before we get to the Q&A section, I just want to thank you both, as well as CrossCountry Mortgage, for providing such an informative presentation. I hope everyone attending this program has found it valuable. And again, we're in the Q&A section, so please come forth with any questions that you have. I'm also dropping 2 links in the chat for LVAIC, other upcoming LVAIC events, as well as our newsletter sign up, so you can get this straight to your inbox. But again, I am now going to stop the recording and we will move to our Q&A section.